It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
And welcome back to another episode of the Real Estate Breakfast, talking property news as we do 7 days a week. Nice to get Monday out of the way, up to a Tuesday. Of course, you can hear us on iHeartRadio, Spotify, Apple Podcasts and Amazon. Yeah, the 30th today, 30th of July. And we are not far away, of course, from another RBA decision day for your mortgage rate. Of course, tomorrow we are going to see what the CPI numbers are going to tell us regarding inflation. The RBA will meet on August the 6th, so not too long to wait. And good morning to Yana, listening in Mossman this morning, soaking up our real estate insights with property news and information. Let us know where you are too, listening to us from. Of course, you might be an expat living in the UK or the US, where we have a number of people listening to the podcast from. And our email address is myrealestatepodcast@gmail.com. Now, buyers with a $750,000 budget, is that you? Well, you can now explore over 400 capital city suburbs across Australia. You might have seen this recently. The Domain House Price Report highlights a wide range of affordable suburbs in major cities, including Sydney. And the report informs us and tells us about a comprehensive list of areas where potential homeowners can find properties within their budget, offering a little bit of a glimmer of hope for those looking to enter the property market in various capital cities who perhaps, and this might be applicable to you, can't move to smaller regional areas around Australia because of work. So let's catch up with Nicola Powell, the Domain Chief of Research and Economics. And good morning to you, Nicola. Welcome back to the Real Estate Breakfast. I do say that about people not being able to move because of work, and that is a real factor when people are almost shackled to their current location.
Very good morning. It's absolutely right. I think it's been interesting with the decentralisation that happened during the pandemic, where people were able to work remotely. It's all well and good if you have a desk-based job that, partly can be done from home. And that means it does open opportunities of you can move a little bit further afield or maybe move into a regional market, and that unlocks the door to affordability for many. But others, are tied to the location of where they work, which means that you need to live within a commutable distance to be able to get to and from work, so you're not spending hours and hours on a train or in the car. Affordability is key, crucial in our major capital cities, that we do have pockets of affordability and a diverse array of housing to drive that affordability for Australians.
Yeah, and I know of one person, at least one person in Sydney, who looked at the juggling act of, I am sort of shackled to my job. But she decided to move and quit her job and go into a completely different industry, also being able to at the same time get into the property market. So some people decide plenty of courage is required here to just do it,
Absolutely, I think so. And I think we saw a lot of brave decisions being made during the pandemic, which really, created large amounts of change where, Australians are generally driven by lifestyle. And if you can find work-life balance by perhaps changing industries or moving to a different location, then good on you for being able to drive that. And I think during the pandemic, I think we all had that kind of realization that work-life balance is really crucial, it's critical. But I also think it is very important for us to remember that, if you're a doctor, if you're a nurse, if you're a firefighter, if you're a school teacher, you are tied to that location of where you are employed because you need to physically be there to be able to do your job. So I think it's very important that we speak about affordability and we think about those different solutions that can drive greater affordability in our most expensive suburbs. I mean, Sydney's house price is eye-watering at $1.66 million. It's unreal.
Yeah, exactly the point. Why I guess somebody might quit their job. Now, let's go back to these properties, $750,000. You're saying that the trick in securing a house with that budget is knowing, of course, where to look. And that could mean having to search a little bit further out from the inner city. And that is the key, is where to look.
Absolutely. And I think $750,000 also looks very different depending upon the capital city in which you're purchasing. Obviously, $750,000 won't go as far in a market like Sydney that has a $1.66 million median house price. But somewhere like Perth, where the median house price is sitting at about $850,000, $750,000 will get you much closer to the CBD relative to what you could purchase in Sydney. And I think, we were talking about house prices here, and I do think, the Australian dream is to own a home. I think we're seeing a little bit of a reshaping of what that Australian dream looks like. I think we're seeing more of us live in apartments and units. More of us live also in townhomes, townhouses or terraced homes. But I do think that people do strive to purchase a house. It's that quarter-acre block. It is that foundational dream that has, been a pillar of our housing markets for many, many years. It is being shaped quicker in some cities that are much more expensive. But I do think the key is knowing where to look, but also knowing the market dynamics, because it is a really timely reminder that we have multiple property cycles going across Australia and even within cities. So you can find that market dynamics at a suburb level can be very diverse. The west of Sydney will perform differently to the inner and the CBD areas. So it is knowing what is it a seller's market? Is it buyer's market? Does that favour your negotiation power? Making sure you're in tune with what's happening at that localised suburb level that you're interested in purchasing in.
It's really fascinating if you go back 10 or 15 years, because I know that you're tracking this, and that is the units versus the houses. And those investors, some investors only looked at the units. Many people at the time would have said, well, you're better off to, buy houses because of the appreciation, et cetera, et cetera. They were buying in a lot less. But now, if these people bought, 10, 15 years ago, these apartments, these units, they're sort of laughing all the way because that tightness between those two markets has changed forever now.
It is, and I think you tend to find investors do go towards units. It makes up the bulk of the rental market. They're obviously much more affordable, therefore holding costs are much better. And, it does units do form the basis of the rental market's largest pool. And you tend to find most rental stocks are in that kind of inner and middle, particularly the inner suburbs. But I think when you're thinking about capital growth, investors get into the market for capital growth. You generally find that houses do perform better in terms of capital growth over that longer term, because ultimately the value is in the dirt, and it's the asset, the home on it, the asset on it that depreciates in value, and it's the land component that improves in value. But I think we've seen a rise, we're talking about affordability, we've seen a rise in first home buyers becoming rent investors, which means is a term that means you continue to rent in the area in which you want to live, and then you purchase and become an investor, technically a rent investor, in a more affordable market and lease that property out. That's been a rising trend, particularly in a market like Sydney, which has great affordability barriers to gaining entry. But, there is a diverse array of housing across our cities, and generally speaking, that affordability for houses increases the further away you get from the CBD, and that's largely because of that land component I was just talking about. Land is more valuable and comes at a premium in inner city suburbs.
Now, Nicola, we should sort of circle back to what I highlighted at the top, and that is the RBA. They've got their meeting coming up on August the 6th. How important do you think this particular meeting is going to be for mortgage holders?
I think that mortgage holders are probably approaching it a little bit with nerves. I think with inflation running higher, and inflation has been bumpy, it came down, it's gone up a little bit. But overall, the trajectory has been inflation is cooling. But I think ultimately the recent data that had come out where it wasn't cooling as quickly as the RBA would have liked, I think the quarterly inflation that is due to come out very soon is going to be very key in helping shape that decision from the RBA. I think the market at the moment, you have market pricing where it's basically betting on where the RBA are going to go. There's about a 25% chance of the RBA increasing that cash rate. I'm going to layer that with my own thoughts. I think that we're much more likely to see the RBA hold. And I think that the outlook is stability for the RBA. And I think they're just going to continue to hold the cash rate. It means that overall the cash rate is going to stay high for longer. But I do think that still I am in the true belief that we are likely to see the next move from the RBA is going to be downwards. But I think with the bumpy road that inflation has taken, it means that the rate cuts are not going to come until the early part of next year. But I think it's highly unlikely that we'll see another rate rise from the RBA.
All right, so there you go. You've heard it from Nicola. Yeah, it seems that the second quarter of 2025, that's where most of the economists seem to be placing their money for it to come down. Just before we finish up, I just want to sort of come back to something that we were talking about a couple of days ago. And that is the interest rates. It's been sort of reported in various circles, both overseas and in Australia, that these very extreme low interest rates, some are saying that we might never ever see those again, 2.5% interest rate in our lifetime. What do you think about that?
I think that the likelihood of us seeing the cash rate go as low as it was during the pandemic is very unlikely. I am in the true belief that I don't think I'll ever see that again in my lifetime. I think it was a highly unusual scenario that presented really unique economic conditions for governments and for policymakers, for the RBA also. We talk about what is the norm for a cash rate. I don't think there is a norm for where the cash rate, or cash rate neutral is what they call it. I think that what we have seen is a highly unusual period of time where we saw the cash rate extremely low. It's very unlikely that's ever going to go back to that point again. I think, though, we've got to remember in Australia, there is more mortgage holders on variable interest rates than fixed rates. So theoretically speaking, what that means is when the RBA does make a decision in the cash rate, mortgage holders, a larger portion of them feel it instantly because they're on variable. When you look at the US, that's not the case, and the same for the UK. So it takes a little bit more time for that to be felt by mortgage holders because the majority are on fixed rates. And I think when you look at the cash rate at the moment, we're still much lower than what's in the UK and the US. But I think what I've just described really provides that case for the cash rate remaining lower than those other kind of global comparisons. But I think the cash rate that we saw during the pandemic, I think that was once in a lifetime.
Yeah. Oh, how sad, how depressing, how depressing. All right, well, we'll wrap it up there, Nicola. Great to chat. Enjoy your Tuesday, and thanks for coming on to the Real Estate Breakfast again.
Thank you.
Gain insights with exclusive conversations from real estate professionals about buying, selling and investing across Australia.
So it's not that housing in Mansfield or on the Bass Coast is all of a sudden dirt cheap and super affordable. It's just that a certain segment of buyers is leaving the market, and then this leads to relatively strong drops.
When they're talking about stagnation, they're also linking it to weak population growth. We are a global migration nation.
The vast majority of migrants in Australia, around 80% or so, are 18 to 39 years of age. This global population of 18 to 39-year-olds is stagnating in about a decade and a half, and it will then decline soon after that. So that means we are increasingly running out of global migration-aged population.
We connect you to the best real estate information across Australia. The Real Estate Podcast.